Hello, Happy New Year, and welcome to Arnerich Massena's fourth quarter 2018 MarketCast. The close of 2018 brought a significant shift in capital markets and investor sentiment as stocks sold off fairly considerably to close out the year. Many of the risks we alluded to in the third quarter MarketCast came to bear during the quarter, but there's a lot of interesting pockets of opportunities for investors to consider going forward. Senior analyst Arthur Coyne and investment advisor Kate Deines are here today to recap the quarter and the year, and more importantly, look forward to the future and how we're positioning client portfolios going forward. Thank you for joining us today.
Stocks fell sharply in the fourth quarter as the Federal Reserve continued to raise short-term interest rates and sell securities from its balance sheet, adding to worries of slower growth in 2019. Against these headwinds, investors also steered away from economically sensitive high-yield bonds toward lower-yielding safe-haven government bonds. When we look at the full year's results, we see that stocks were down significantly, while bonds roughly held their value. To put the recent U.S. stock market volatility in perspective, let's look at the number of days each year that the S&P 500 index was either up or down by 2% or more. Unlike 2017, when the S&P 500 index had no 2% drops, there were 15 days in 2018 when the S&P 500 index fell 2% or more. Historically, market volatility has been fairly symmetrical. You can see the mirror-like images with the number of 2% up and down days being approximately equal in most years, but 2018 was a little unusual in this respect, with significantly more 2% down days than 2% up days. So why did volatility come back? Perhaps one of the biggest contributors to the volatility has been uncertainty about what might happen to U.S. economic growth and corporate earnings in 2019. In this chart, we see that at year-end, forecasters were predicting that U.S. GDP growth rate would decline from about 3.1% in 2018 to about 2.3% in 2019. And analysts expect corporate earnings growth, which is critical to stock valuations, to slow from 24% in 2018 to 13% in 2019 on changes in labor costs, tariffs, demand, and the roll-off of the earnings boost from last year's corporate tax changes. Add some rising political uncertainty to the mix, and it looks like fourth quarter stock volatility was more about concerns about the future than concerns about the present. Now let's compare 2018 to 2017. In 2017, stocks had very high returns, lifted by a combination of rising earnings growth and rising price-to-earnings ratios. But in 2018, stocks gave a lot of that back, as price-to-earnings ratios declined sharply, even though earnings continued to grow. When we compare U.S. and international stocks, we see that U.S. stocks benefited on a relative basis in 2018 from having a stronger earnings growth outlook and an appreciating dollar. The end result? Based on forward-looking price-to-earnings ratios, international stocks closed out the year looking a lot more attractively priced than U.S. stocks. Stepping back from the short-term ups and downs of the market to look at the long-term big picture, we need to keep in mind that most of the world's fastest-growing economies are located in Asia and Africa. Not only does Asia account for 60% of the world's population, but its economy was expected to grow at over 5% in 2019. And looking a little bit further into the future, Africa is poised to be another major growth center. Beginning in 2035, the number of African young people reaching working age is expected to exceed the rest of the world combined, and this will continue through the end of the century. But for owning stocks to be attractive, you need more than just good growth. You also need the price to be right. This heat map shows each country's forward price-to-earnings ratio with the size of each box scaled by each country's share of the world economy. The dark red countries have the most expensive stock valuations, and the dark green countries have the least expensive stocks based on their forward-looking price-to-earnings ratios. From this chart, we can see that not only does the United States have the largest economy in the world, but its stocks are also among the most expensive in the world. This means that for U.S. investors, international stocks can offer both diversification and value opportunities. Now I'd like to introduce investment advisor Kate Deines, who will put this into a portfolio context.
Thanks, Arthur. Our tactical views continue to focus on finding long-term opportunities in this current market environment. for 2019, we see some of the most attractive stock opportunities in foreign markets. And for this reason, we are overweight international relative to domestic. Value stocks are also another area in which there are ample opportunities that we are actively implementing within client portfolios. And in this bond market environment, coupled with rising interest rates, we continue to favor lower duration bonds and high quality credit. As always, your advisor will keep you informed about specific investment opportunities as they become available. For more information, please feel free to visit us at arnerichmassena.com. You might also enjoy listening to our recent podcasts, Technology and Transformation, Investment Trends to Watch For in 2019. This can be found on our blog, on our YouTube channel, and also on iTunes. And please stay tuned for an upcoming podcast that will be coming shortly, in which our research team takes a deeper dive into what happened in the markets last year and what their outlook is for 2019. Thank you so much for joining us today.